Memory stocks have been in the gutter lately, with many names down hard over the last 4 to 6 weeks. Some people have even called this the beginning of the end for the AI trade broadly, with some legendary names on Wall Street outright shorting stocks in this space. However, I think this is a classic case of people seeing patterns that simply don't exist and confusing price for value. Just for context, Micron recently posted the best quarter in the company's history, with revenue up 346% year over year to $41.4 billion and gross margins near 85%. Yet, despite this, the stock crashed 23%. Then, this week, it ripped back up double digits, and it wasn't alone. So, which is it? Is memory a broken cyclical trade that's about to roll over again? Or did the market simply panic and just got embarrassed? By the end of this video, you'll have a better understanding of this space and what to look out for on July 29th, the one date that tells us if this rally is real, if it has legs, or if it's about to blow up in everyone's face. But first, welcome back everyone to the Lunch Money Investing channel, where you get an ex-math econ nerd, that's me, to watch the market for you and break down 1 to 2 market moving events each week so you can make more informed decisions for your portfolio. And of course, grow that lunch money. If this type of content sounds interesting to you, please consider subscribing. It's free and it helps me know that this type of content and analysis is genuinely helpful for other people. Anyways, let's get into the main story. So rewind a couple weeks and you'll see that memory stocks like Micron, SanDisk, and SK Hynix, the Kospi index listing, are all down 25 to 30% off their highs. On the surface, this stock reaction makes total sense. Memory stocks have always been the poster child for cyclical tech, where demand spikes, everyone overbuilds, and prices come crashing down. You wait it out and eventually the whole cycle repeats itself. If you've followed this sector for more than a few years, you've seen this movie before. You know exactly what happens. And it's not just random people weary of the memory space. Michael Burry, yes, the big short guy, is short Micron right now. And he's not just using put options to gain exposure to the downside. The guy is outright short the stock. This isn't some random person on Twitter. This is a person with a real track record of being early on seeing things that everyone else ignored. The bears have a real argument, and it's a simple one. Memory pricing is famously boom and bust. Companies overbuild capacity when demand is hot, and there's no denying that right now it's hot. Supply floods the market, prices crater, you rinse and repeat. That's happened to this industry more than once. So why would this time be any different? After all, those are very dangerous words on Wall Street. This time is different. And that's a fair question. Let's actually answer it, because I think people making the call are seeing a pattern from an old industry structure that simply doesn't exist anymore, or at least not to the same extent that it did in the past. And here's the thing almost nobody talks about when they compare this cycle to previous cycles. Take a look at this diagram here. This is a high-level overview of the 5 core layers of the modern AI chip supply chain. Each layer consists of multiple players, and the entire chip itself is its own economy. Layer 1, you have the design layer. That's the NVIDIAs of the world that draw up the actual chip architecture. Layer 2, that's the fab, manufacturing of these chips. Example is TSMC. Layer 3, that's the star of this video, is the memory layer. Here we find Micron, SK Hynix, Hynix, and other names. Those are the companies supplying high bandwidth memory that feeds the chip's data fast enough to actually keep it going. A processor can't process if it's not fed data. Layer 4 is the packaging and equipment layer. Here we find ASML and their advanced lithography machines that are literally very fancy 3D printing machines that are accurate down to nanometers. And layer 5 is the system integration layer. Here we find Supermicro, Dell, HPE, and other names. All the companies that actually assemble all this stuff into servers that get shipped out to data centers. One GPU, 5 different layers, 5 different industries, and 5 different cycles. And that's not even accounting for the raw material producers that actually pull raw silicon out of the ground. So here's the main point. When people say memory is cyclical, here we go again, they're talking about an industry structure that used to be true, where 1 or 2 players owned the majority of the chip production cycle. But that's simply not the case anymore. Cyclicality hasn't disappeared, it's simply diffused into the 5 different layers of the AI production cycle. And each of the 5 layers is moving on its own timeline. And even within a specific layer, the memory layer specifically, the business itself is evolving and looks different than what it used to be. As an example, Micron just locked in 16 long-term customer agreements, $100 billion in committed revenue through 2030. SK Hynix is doing the same thing with long-term agreements, similar to Micron. That's not a company hoping prices stay high. These are companies that are already sold out for the next several years of production at set prices. You cannot get that kind of demand visibility during a boom and bust cycle. Cycles are unpredictable by definition. Contracts aren't. Then there's the supply side of all this. The CEO of SK Hynix said publicly that shortages will persist at least through 2028 and likely beyond that. That's not a guess about demand. That's the person who runs the plant telling you they physically cannot make enough of this stuff. And here's the part that should really make you rethink the bear case. Cheaper and more efficient AI models. At first, that might sound like it'll kill demand, but that doesn't kill demand. It actually increases it. The cheaper and more efficient something gets, the more it'll get used. When your fuel efficiency goes up, you don't drive less, you drive more. The same thing is true for AI models. Cheaper prices and cheaper models mean more usage, which means more demand for memory. And this increase in efficiency sets up the next leg of this story too. Companies like Samsung and SK Hynix are already building an entirely new tier of memory called CXL, specifically to expand the capacity, the memory capacity, beyond what is physically possible today. They are basically intelligently placing data on the chips to increase efficiency. And that's, there's a whole other process that goes more detailed than what I can cover here. But basically, that's another multi-year growth lever that nobody is pricing in today. Okay, so remember layer 5, the system integration layer? Here's what happened recently. Supermicro just told investors their margins are coming in way higher than anyone expected for the quarter. Not a small revision either. They went from a projected 8% gross margins to now around 15 to 17%. Nearly double initial projections. Why? Because in their own words, a surge in new orders, a surge in demand. This is not a hyperscaler talking about a spending plan on a slide deck. That's an actual server builder telling you orders are stacking up today. And it wasn't just Supermicro. Other players in the integration layer shared similar stories. AI server demand is translating into real immediate revenue today and for the foreseeable future. Now follow that money one more layer up the stack, and we see the same trend. Google just reported earnings earlier today, and Google Cloud revenue grew 82% year over year, hitting $24.8 billion. For context, the streak was looking only for 65% growth in revenue. This is far outside those expectations. This wasn't a modest beat. This is crushing analyst expectations. Cloud growth accelerated and management pointed directly to enterprise AI infrastructure and AI solutions demand as the primary driver. Zoom out now, and the whole company backs this up. Google's total revenue hit $119.8 billion, up 24%. That's now 12 quarters of straight double-digit growth. Operating margins expanded 2 full basis points to 34%, and Google CEO stated it plainly. Cloud's acceleration was driven by demand for AI infrastructure. This isn't Google telling us that money will be flowing in someday. This is Google telling us right now that AI infrastructure demand is already showing up as realized revenue, growing faster than anyone expected. That means the money keeps flowing to companies building AI servers. And we just watched Supermicro's margins jump up because their orders are already landing. And every one of those servers needs more memory to function. No memory, no servers. You need servers, you need memory, right? That's the chain. That's not a theory anymore. That is what's happening right now, and it shows no sign of slowing down. And the broader market agrees with this. This week, Micron, SanDisk, SK Hynix all moved sharply higher without a single new piece of company-specific news. The move wasn't driven by a headline from any one of these companies. Instead, it's the market recognizing all at once that the fundamentals of these companies never actually broke. Instead, investors misunderstood the story. So where do we go from here? Mark July 29th down on your calendars. That's when SK Hynix reports earnings, and that's genuinely a big day. Here's the setup, and it's a strange one. Analysts expect SK Hynix's best quarter in the company's history. We're talking about operating margins north of 70%, numbers that would sound insane 2 years ago. And yet, some major brokerages have actually trimmed their forecasts slightly going into the results. That's the paradox. Record-breaking numbers clashing with a market that has set an almost impossibly high bar. Even if SK Hynix hits the lower end of its expectations, that's still something like a 500% increase year over year. 500%, these are insane numbers. But because expectations have gotten so extreme, great and not great enough have become a razor-thin line. This single earnings report is going to tell us whether this rebound has real legs or whether the market has got ahead of itself. Now, I'm actually playing this personally. Obviously, I don't like to bet the farm on any one name. You know me, I like to be recklessly safe. So I'm not betting on any one name. Instead, I'm betting on an ETF that holds a basket of these names. I'm looking at DRAM, so it's a diversified memory ETF, right, that has exposure to Micron, SK Hynix, Samsung, and other big names, rather than trying to pick a single winner. That's not because I'm hedging and I'm unsure of the trade, but more so, I'm in the business of building a robust portfolio that can survive a range of outcomes, right? So I don't want to be tied to any one company. I want to be tied to instead the secular trends that are building out this entire industry. And I'm humble about my ability to see the future, right? As I've mentioned before, I don't have a crystal ball. If you have one, hit me up in the DMs. But anyways, obviously this is not financial advice. I'm just sharing what I'm doing, right? That's why we're here. So here's where we land. The sell-off has already happened. The rebound, if you haven't noticed, has already started. And most people watching the news from the sidelines this week had no idea what happened. The real story now isn't whether memory crashed. Instead, it's whether the July 29th report from SK Hynix gives us new fuel for a new leg higher. And of course, when that earnings report comes out, I'll be bringing it down here on this channel. So be sure to subscribe. And obviously, if you haven't already, like this video. Anyways, if you found this information useful or insightful in any way, please subscribe. Again, it means the world to me, right? It's free and it's a small way to show me that, hey, this stuff does matter and it is useful to other people. Anyways, I'll see you in the next video. And as always, protect that lunch money.